All right. Sorry, everybody. We just go live now. So we are talking about whole life insurance. We have already finished the term life insurance. We are looking at the characteristics. What makes whole life insurance very special? One of them is that it has a face amount. That face amount, which you call the death benefit, is also called the face value. Face amount, death benefit, and face value is just the same word, meaning they mean the same thing. So it's leveled, fixed. You cannot change. Whatever this your face amount or your death benefit is what it is. That's what you're gonna get. However, it has a cash value, which is increasing based on the funding of the policy. As you fund your policy well, what happened? The cash value continues to generate, building up a reserve for you that you can borrow or that you can withdraw, depending on what your need is. And remember, I said you have to buy policy based on your needs. Now, whole life or straight life have what premium is level 2. However, that premium is level, but you can pay it as you want in different modes. You can pay monthly, you can pay annually, or some people can even pay weekly if you want. So that is the 3 things you should know about whole life. Now, let's look at, we're not gonna waste time on this. So if you look at this example, you say, why term life is designed to provide temporary protection. Of course, everybody knows that term life is provide temporary protection. If the insured dies too soon, whole life insurance is designed to what? Provide permanent protection when the insured dies. All right. So cash value. Of course, we talked about cash value. You have known what the cash value is. We're not going to go through it. All these are whole life. This application scenario. So look at this example. Say there is a specific return of cash value benefit rider that can be added to a whole life policy. If an exam question doesn't explicitly mention an insurance policy having a return of cash value rider or endorsement, it should be assumed that the policy in question doesn't include that rider. So the rider has to be mentioned.
We are not seeing, you're not sharing.
I'm not sharing?
Yes.
Oh my God, why don't you guys tell me? And everybody keep quiet. Sorry, I'm pleased. Oh my God.
Just now, after you went live. Just now. We've been sharing since.
All right. Is it okay now?
Yes.
Yeah.
Oh, sorry, I'm pleased. Sorry, everybody. All right. So that is the whole life we're talking about. Maturity age. Whole life, we know the maturity age of whole life is 100 years. Why do we say 100 years? And why do we say maturity age? What it means now is that at the age 100, what happened? The first amount that you have bought, it may be bought policy of 500,000. That first amount, which is 500,000, will be equal to the cash value. Remember, the cash value is increasing depending on their funding of your policy. So they're telling you that in whole life, the maturity age is 100. At 100, that first amount is now equals to what? The cash value. So when it turns that way, what happened? You are no longer expected to pay any premium again. Because if you're paying premium, remember, when you pay premium, there'll be cash value generated. Already the cash value have reached its peak. Then you can now say that that policy has been fully funded. Fully funded. Because the cash value is now equal to the first amount. And then you cannot add more money. Adding more money means that you're paying more premium. So you can no longer pay premium. People can now describe that policy to have been funded or to have been matured or endured. So no more premium can be paid. So in other words, most insurance company, what they do, they check the policy face value. They minus any outstanding policy loans. If you have any policy loan, if you don't have, well, then you stop paying. Your policy is still there. So that is it. But the question is how many persons will reach 100 years? So you see that why it's called a permanent life insurance. It give you protection for the whole of your life. The term like that. So we talk about the premium. I want us to go to the types where there is the basic forms of whole life insurance, the basic form of whole life insurance, which we have described before, the basic forms. Now, remember we mentioned all of them, which they mean the same thing. Now, let's look at, it said the policy cash value increases with each premium payment. So the more you pay your premium, the more cash value generates. A fixed interest rate is paid on the cash value, which in traditional policy is also fixed for the life of the policy. Therefore, the cash value build-up of a whole life policy equals the face amount at age 100. The contract also includes non-forfeiture option or values if the policy owner wants to surrender the policy. You see, that's the one good thing about whole life or permanent life. Remember, in term life, if you surrender a policy, none of your money will pay you back, except you have return of premium rider attached to your policy, which must come in during the time you are applying for the policy. Can you add return of premium rider in term life insurance in middle when you must have paid 2 3 years? No. The contract will be signed and binding, so you can no longer do nothing on it. The advice they will give you is to go and write on that policy, or you terminate if you don't want. Of course, it's a contract. It's a contract of adhesion. You take it or you leave it. The insurance companies in their house, you follow them go. You find them go to their house, so they're gonna give you conditions. It's contract of adhesion. Either you take it or you leave it. They're not forcing you. So in term life, definitely you're not gonna get nothing except if you surrender. Except you do what? You have return of premium rider. If they bring the premium, what they're gonna do? They're gonna remove all their administrative fees and every other fees attached to it. The remaining one will be given back to you. But however, is it not better to get something than not to get at all? A lady terminated her term life. She was complaining that look, she didn't get anything out of it. I asked her, did your policy have return of premium rider? I said, what is it? I said, that's the main reason why I didn't get nothing. So all of us were just laughing. So if you add it on time, you'll get it. All right, so let's look at stretched whole life. The basic forms of whole life, stretched whole life. The most basic form of whole life insurance is stretched whole life, also known as ordinary whole life. This is the one that everybody is buying, even everybody. When you talk of somebody bought a whole life or bought a permanent life insurance, it's stretched whole life. That is the one everybody is buying. When they now buy it, you now add some riders in it to make it beneficial. So stretched whole life insurance is the standard definition of whole life insurance as described up to this point. It's whole life insurance. It's a whole life insurance that provides permanent level protection with level premium from the time the policy is issued until the issued death or age 100. So this is what everybody buys, stretched whole life. So the continuous premium or whole life plan is what characterized by a level or fixed premium as long as the contract remains for fixed or level premium. Fixed or level premium, which means the premium remains the same. Whenever you hear level, it means that the premium does not change. When you hear about level death benefit, it means that the death benefit remains the same. The first amount remains the same. The face value remains the same. That's level. If you hear level premium, it's the same, or fixed is the same. Then inside that level, which is the same, each payment is flexible, means that you can pay today this amount today, tomorrow you decide to say, I'm gonna change. So, I mean, you want to change your premium mode, premium mode means that the payment mode, the way you pay your policy, if you're paying monthly or annually or semi-annually. So all those are attached to it. So, limited pay whole life insurance, limited pay whole life. What by the name you should always know them. We say by their word we shall know them. Limited. You do not pay throughout the whole until the policy matured by 100. The maturity of the policy can be before the age of 100. That is exactly what it's telling you here. Normally, maturity is in our policy indoors or policy fully funded at age 100. But in limited pay whole life insurance, it doesn't apply that way. It's, however, in form of term life insurance. What I mean by that, you specify a year that you will complete the payment. You can say, just like as in your home mortgages, some people do their mortgage for 10 years, some 15 years, some 30 years. You can say this whole life, you want to complete it within 20 years. In that case, they call it 20 pay life. Or you can say 10 years. In that case, 10 pay life. Or you can even decide for 30 years. It becomes 30 pay life. That's limited whole life. Any question? So any question on where we are now, please? Anybody? Any questions so far? So anyway, it's just what we have done before. So limited pay life, limited pay whole life. Whenever you see it, they are telling you that it's not a straight life. Straight whole life is you have to pay until the maturity age, which is 100 years. But when you say limited whole life, means that that's maturity age of 100 years. You don't want to reach like that. You don't want to reach up to 100. You want to pay it within 20 years. You want to pay off you want the policy to mature out indoor before age of 100. That is the limited. You can say 30 pay life, but one thing I want you to pay attention on, which you will see in questions, is this place I highlighted. Apart from knowing what limited pay life is, you have to know when this pay, what 20 pay life means, 30 pay life, 10 pay life. What basically it means is this. This is the year the person have chosen that he will complete the payment. That is complete funding of the policy. You know, in straight whole life, the funding or payment of the policy will continue until age 100, when what? Face amount will equal to the cash value. But in this time around, you don't want it to wait until age 100. You want to pay it on time. You can say 20 pay life or use 30 pay life. You want to use 30 years to finish up the payment. Yes, you can do that. That is limited pay whole life insurance policy. All right, so another one, single premium whole life insurance policy, which means you want to pay it at once. Single premium.
I have a question.
Go ahead.
So the word limited does not mean that the coverage is limited. It applies to when the payment of premium is completed. Is that?
Correct.
Yes.
Correct.
That's what it means.
That is the meaning, yeah. It means limited, they're talking about limited pay, means that the period in which you can
Complete.
mature, you complete the payment.
Okay.
You don't have to wait till 100 years.
You don't have to wait till 100 years, which means you can pay it within 65 years to finish, or within 30 years, or within 20 years, depending on how you want it.
Okay.
Yeah. Yeah, that's a good question.
Yes.
So single premium is you pay one time. You just decide to pay one time, which the insurance company have to make sure they plan it well for you to avoid the policy going into what we call MEG, matured modified endowment contract, because you don't want your policy to go to modified endowment contract. So single premium whole life insurance is insurance you pay, straight life you pay till age 100. Limited life you pay at the year you choose. You finish payment at the year you choose. Then single premium, you decide that you don't want to go to 100 years. You don't want it to pay 20 or 30 years or 65 years. You want one day. That day you buy the policy, you clear it. So that is single premium, you pay at once. But however, the only issue that involved with single premium plan is what? The issue of modified endowment contract, MEC. So if you fund your policy more than what is expected, what will happen? That policy will go to MEC. And when it go to MEC, it loses what? The free tax benefit the life insurance is getting. When it loses it, what happened? The death benefit will be taxed, cash value will be taxed, withdrawal or anything, or loan will be taxed. Anything in that policy, it will be taxed. So because now the IRS no longer sees that policy as an insurance package portfolio, they see it as what? Investment portfolio. So that's when you pay single premium. That's single premium whole life. Then this is application scenario. We're not gonna go through that. So if you can see that in whole life, in permanent life, we have three types of policy. Who remember the three types of policy?
Yes. You have adjustable.
Uh-huh.
You have universal, and you have variable.
No. You are going too far. We are never
Okay.
reached that side. I'm saying in term life insurance, we have three types of policy.
Okay, we have level term.
Decreasing
We have decreasing and decreasing term.
Good. Now, in whole life, we have three too. Did you recognize that we have three?
Yes.
We have threats, we have limited, we have single.
You don't need this kind of jacket now.
So
Need one
that's
this is for-
what, and at least everybody here knows what the three means.
Go get big
Now,
jacket.
what we have done since, we have discussed since, is what? Traditional whole life insurance, where we have three policies, types of policies. Three types of policies. That's what we have in traditional whole life. We have what? The threats, we have the limited pay life, we have the single premium life insurance. So that's what the three types of we have in whole life insurance, traditional whole life insurance. Now, let's move to non-traditional whole life. The non-traditional whole life is what everybody wants. Most people want it. So
Why?
yeah, I'm going to explain. Why most people want it is this, because there's so much security on it.
Okay.
That is where you can get the index. That's where you can get fixed.
Okay.
So there's more security on it, and that's called non-traditional whole life. It's an element of whole life with what? Some element of term life put together, giving you the best protection.
Okay.
So now we're going to go through to find out the types of policy in non-traditional whole life. One of them is modified whole life insurance. Modified whole life insurance is what a whole life insurance policy characterized by an initial premium. This is where it gets messy. And this is where I want everybody to pay attention, because most times people will get it, we not get it incorrectly, and in questions normally come out of it. The non-traditional whole life, we have three, as we have three, all of them, we have three here too. The modified whole life, the graded whole life, and the next one is, let me see the next one. The next one is enhanced whole life. So we're going to see those three now. Please pay
Enhanced.
attention to them. So let's start with modified whole life. This one is based on how the premium is paid and how the premium is increases. In all this traditional whole life, we're going to see the increase in premium and the decrease in premium. How, if you are paying, how your premium will increase. So in modified whole life, initially you're going to pay premium that is very low. Then that premium will be very flat, very low, and initially you'll be paying it. Then within some few years, this premium will go up. And it will continue like that. That is modified whole life. Initially, the premium is low. Then with time, it increases. So most time, the policy owner will pay a lower premium or flat initial premium at the beginning, first few years. Sometimes 3 to 4 years, you are paying small premium. But after that years, the premium will increase. And if you go to that higher amount, it will be straight. That is, will be level. It will run down like that throughout the life of the policy. So that is what modified whole life insurance. So you see why we're saying this, so that when you are writing a policy, you have to choose the one you want. So the premium increase following the initial period, the premium changes once and then remain level of the life policy. You're definitely going to see this type of thing in the exam. Therefore, the modified whole life insurance premium is characterized by two fixed premium. One, the lower initial premium within 3 to 10 years, that then the increase of the amount that will stay like that till the life of the policy. So that is modified whole life. Now, let's go to graded whole life. This is another type of life insurance, graded whole life. Graded is another measure to know how your payment will be, just like the modified. Remember, the modified initially increases. Initially it's very low. Within the first 3 to 10 years, it's very low. Then it increases and now to highest and now remain that way throughout the life of the policy. Now, the graded is still the same thing. The graded, you start with an initial low premium. But what happened in this one increases annually. Instead of waiting till being low for 3 to 10 years, this one, it increases, when it starts to increase every year, annually, until you reach a point where it will remain the same. The premium will remain the same. What are we talking that increases the premium? So you want to now decide whether graded you choose or whether modified you choose. So please know what you mean by graded. I will know what you mean by modified. You're likely going to see them in the exam.
Engineer,
Uh-huh.
the exam FX I'm using for Illinois,
Mm-hmm.
there's never a place I met graded and modified.
Check well. Is there?
I've gone there severally, So after they finished the traditional whole life, they went to interest sensitive, which are adjustable,
Oh, yeah.
universal, and variable. So I never came across that. I don't know why.
Sorry?
Yes.
All right. I think I will check. I'll log in and check.
Okay.
I'll check.
Okay, sir.
But I believe it should be there, modified and
I've
graded.
checked.
And it's always in the exam. I'll tell you the truth.
Mhm.
Modified and graded premium whole life is always in the exam. So sometimes they will ask this as a scenario question.
No question.
This issue of you start to pay low at a point increases after 3 to 10 years increases. Now it remains the same throughout the life of the policy. And the graded, it is you pay low from the beginning, then it increases annually until you get to a point where you continue to pay the same. So I think the definition is, anyway, it's not more, even if you don't see it, I just know it now.
Yes,
Just know the
I've done
definition.
it. Yeah.
But I think I will check whether it's there or not.
Okay, sir.
All right. So let's look at enhanced whole life insurance, which is economatic or extraordinary life. Most often, the one I know definitely you're gonna see in most of the question is graded or modified whole life. This enhanced whole life, I'm not even seeing it in the question. All the review questions, I cannot see any of them there. Enhanced or economic extraordinary life. So, but however, what it is that it referring to economic life or extraordinary life is a low premium participating permanent insurance policy. When you talk about participating, everybody here should know what participating means and where it's going from. So who doesn't know?
I don't know.
All right. So when you are talking about premium or policy, you hear of participating. It's coming from a companies that says participating policy.
Very good.
That's mutual.
Which is mutual company. So this one is based on the company type. And that's why it's not generalized in terms of seeing it in the exam. It's specifically for them, mutual companies. So you can only see enhanced whole life insurance or economatic, also extraordinary life in participating companies.
Okay.
That's where you see it. And
Okay.
then people that can share dividends, share profit to you in form of dividends.
Okay.
Yeah. So in this type, what happens is that the first amount most times will reduce each year. First amount will reduce, and they will pay you dividends, of course, in form the profit. They share the profit they made the year with you in form of dividends. So you can now use the dividend to purchase extra life insurance, which normally is 1 year term life insurance. So it's a messy type of policy. So that's why they don't actually, you can't actually most often see it in the exam. It's very messy. I don't think anybody will go for that. Because imagine you bought a policy of 500, and with time the policy will begin to reduce, and because they're paying you a premium, they're paying you dividends. You now use the dividend to buy.
You get another one.
You get another term, not even another one. If you get another one, but this one now, term insurance. So it's
Term
very,
insurance that doesn't have cash value.
so it doesn't, that's why they're not, you can never see it in the exam though. So the indeterminate premium whole life insurance is the type of whole life policy that offers low initial premium for specified period. After that period, the insurer may then increase premium. So you see why this one is something you would not even want to talk about. Any policy that premium can increase at will, I don't think, me personally, I may not like it. That you are paying $200 today, tomorrow they tell you, say it's no longer 200, it's a 400. You're not gonna want it. In fact, if they add 1 cent to that premium, you get frustrated. Say, what is this? What is going on here? Just like you are paying your mortgage, they said tax. The city has increased tax. They wrote you a letter that your mortgage, you're paying $1,000. It's no longer going to be $1,000. Now it's going to be 1,200. When you get that, you make a sign. You just sign. What kind of nonsense with this? You get to rebudget yourself to be able to pay off that mortgage. So in this indeterminate premium, the premium is very, very indeterminate. It has not been determined. So you may go low today, tomorrow they increase it at their will, depending on whether they're making gain or they are losing. So, and most often, which type of insurance you can see is still mutual companies, because mutual companies is the only one that can adjust their premium when necessary. When they are losing. Most often, I've never seen insurance company that lost too. So we have current assumption whole life. We're not going to interest sensitive whole life. All right, this is what she said she saw. So the current assumption whole life also refers as what? Interest sensitive whole life and excess interest whole life is characterized by what? Premium that vary to reflect the insurance charging assumption concerning its debt, investment, and expense factors. However, interest-sensitive products also provide a cash value that may be higher than the guaranteed levels. You know why it's called interest-sensitive? In fact, everybody's looking towards that. Me, I would prefer that because this particular policy is sort of, although we do not call it investment, but it's more of an investment. So that's why when you are writing policy, you have to know the need why you are writing the policy. Is it about investment? Is it about maximum protection? Is it about to take care of you when you get old in terms of long-term care? All those factors what you have to consider before you say you want to write policy. But when you don't know, you just go to write policy. Then the agent will now design based on question he or she asks you. I know most times the design we give people is based on questions and submissions in terms of their financial need analysis. That will determine actually, one, the amount of policy you have, two, and what actually you need. Because after the need analysis, you will basically know where you stand financially and even protectively. So that guided. So interest sensitive whole life is what everybody needs. Because of the interest involved. So remember, the assumptions in this particular type of policy depends on the market trend. It does not just happen like that. Or like other ones we have been talking before, you may not see the one directly linked to market trend. Is this one, interest sensitive. So let's look at the characteristics and what they are used for. So look at this. Say, if the company's underlying debt, investment, expense, and assumption are more favorable than expected, policy owners will have two options: lower premium or higher cash value, which could result in higher debt benefit in later years. Did you hear that? What is telling you that here that this particular company, most times they come from mutual companies. I'm telling you, mutual companies are so wonderful. But the only thing is that in case when they lost, but if they continue to gain, you're on the higher side. One, if they continue to gain, there's tendency they're going to lower your premium. Either you get lower premium or you get higher cash values. So that's the things you're going to get there. And all the things we get, sometimes when you get lower premium or higher cash value, what happens? Yeah, the debt benefit will increase. Yes. So what you're gonna pay out when you leave, when the person dies, become much. So there's one question somebody asked me one day. Like you write $1 million policy, and when you write it when you're 10 years or 20 years, and when you get up to 70 years, you're getting close to 4.something million there. They ask, are they gonna pay you the 4.something million? That's one question the person asked me. I said, but one thing you should know is this: whether they will pay you, if they will not pay you, not the factor. What you know is that if you know you have such money there in the cash value, why don't you begin to invest? Why do you want to leave it there? You know, just like you keep your money in the bank, you continue to dump on the bank, 100 million, 200 billions, you have it in the bank. Why do you keep it there? Invest. So that's the question I asked the person. Say, I don't know whether they will give you back or they will not give you. But whether they will give you or not, my answer will be, why not? Why do you live here? Go and invest it. Of course, all of us knows that the only way to grow is investments. So why not take $1 million out of that place, go and start doing something great for yourself. Because the aim of everybody is to become a business owner. Yeah, go on serious business. You can invest it in a real estate. You just bring out $1 million, go and use it, start invest real estate business. By next 10 years, you become a billionaire. Because you have gotten much properties and you are selling and buying and building. So you get money within some years. So the policy owner may then either pay the higher premium or reduce the policy as first amount and continue paying the same premium. So it's in two ways. Either you lose or gain. When you lose, you follow to the lose. When you gain, you follow to the gain. So that is one thing with mutual company. You cannot only be gaining, you cannot lose. But however, if it is fixed index, you're not gonna lose anything. Because it's only fixed and index, you're not gonna lose anything. You only be getting. All right, so let's get out from here. We don't waste time here. Equity index, we're not gonna look at it. Equity index is, of course, is linked to policy linked to equity, SP 500. Equity index, I always like it because you follow the market or the stock market trends. The risk you see in market is exactly the same risk you're gonna see here, but the only difference is that this one is indexed, so you're not gonna lose. All right. This is an alternative non-traditional life insurance product. I know this one. Adjustable life. Let's look at adjustable life, because most people will see it. So this type of permanent insurance product combines elements of traditional fixed premium whole life insurance with the potential to adjust the coverage of first amount based on the policy owner's changing needs. You can adjust it to your taste based on their needs. So adjustable life provides an adjustable death benefit and cash value. So everything you can readjust to what you want. You can have $500, $1,000 policy as the first amount today or death benefit. You want to rearrange it, you can make it 250,000. No, you can make it 510,000. It depends on what you want. You can adjust the death benefit and also the cash value. Why also, and when you are adjusting, you are processing the future, because one thing with it is that it possesses the features of traditional whole life policies.
So in order to adjust for this cash value and the benefit itself, there should be some sort of premium increase, isn't it?
Of course. Remember what we said. The premium can adjust by increasing, or it can equally decrease by. The premium can increase or increase. That's why it's adjustable. And when you know that, when their premium is increased, what happened to the cash value? What happened?
The cash value will increase.
Of course. So when the premium is reduced, the cash value reduces.
Mm-hmm.
So that is, and what of the first amount? When the first amount is increased, what happened to the premium and the cash value?
All of them will increase too.
The first amount, because the premium will increase and the cash value will increase. So all those things depends. Your cash value build up depends on what you are, how you are funding the policy. So the adjustable is this: they give you the benefit, provide you benefit to adjust your cash value or your death benefits. So it means that you can do it based on what you actually need, based on what you need. So most times there is some confusion regarding premium for adjustable life. Look at this. There's always a confusion regarding this premium adjusting premium on adjustable life. In the future, the policy owner may pay more or less per year than the original premium because the premium is adjustable. However, remember the original definition at any point in time, adjustable life insurance is a level premium, level death benefit policy. This means that whenever a coverage amount is increased, the premium that is due is level for the upcoming policy year. Of course, if the policy owner decides to increase the coverage amount, the insured party must always prove insurability. If you decide that the only ugly thing about it, in as much as you can adjust the premium and decrease the premium as you want, anytime you want to increase your face amount, in fact, it's applied to all policies. They can reduce their face amount, but they cannot increase it for you. Anytime you want to increase the face amount, the insurance company must ask you for proof of insurability or evidence of insurability. Because they don't wanna lose. Because if you are reason for increasing maybe because you have a terminal disease,
Yeah.
something that can increase the risk. And when the risk increase, what do you mean? The premium is supposed to increase. So that's what you should have in mind. All right. Now we get to universal life. This is one of the things that everybody is looking for, universal life. What does it do? It provides you, if you have it, a more flexibility compared to traditional whole life plan. Why? Because it has what? Adjustable term life insurance. This is a flexible premium adjustable since it allows contract owner to change the coverage amount at their discretion. So this type of policy may be characterized as interest sensitive as it utilizes changing interest rates or rate of return to determine cash values. So universal uses changing interest rate to determine the cash value. Remember, when you pay your premium and you have some part of it to the cash value, now if it's universal life insurance, now based on the interest rates, based on the market trend, based on the stock, if the market is good, the cash value is building up more. So in as much as we say it's not for investment, of course, that's what's the intention of buying life insurance, not for investment. It's for protection. But you can see the element of savings embedded in universal life insurance due to what? The interest. It based on the cash value increase due to the interest. So these changing interest rates are not used to determine death benefit or future premium. It's only for the cash value. When you have universal life insurance, the interest that affects only what? Your cash value. That interest, that increase, does not affect the death benefit or face amount, neither does it affect the premium you are paying. No. It only goes to the what? The cash value. So if the market trend is good, the cash value continues to build more. If it's less, then you lose. But however, if it is indexed, meaning that it's pegged, the interest is pegged at a particular point. So when it's losing more, it cannot go below that point fixed. So you only gain and not lose. So universal life premium paid for pure protection. For pure protection, that is YRT term insurance. YRT is yearly return term. Let me see. I can't remember what it is again. We have YRT and YT something. Let me see. So any question based on what we are discussing so far? All right. So we have yearly renewable term, and annual renewable term. If they say yearly renewable term and annual renewable term, you can see two of them is not the same word. Yearly and annual is not
That's the same thing.
So variable universal life insurance, current assumption, whole life, CAWY, yearly renewable term and annual renewable term developed primarily in the 1970s. Beyond, these plans are characterized by adjustable or variable death benefit and premium, allowing for more personalized coverage and financial planning. So when you come at this stage of life insurance policy, it depends on what you need, please. It's no longer as usual as maybe you just write the policy for writing's sake. You should be able to know why you need it. You should be able to know the type that can benefit you and your family, not just, oh, write policy for me. You should have something in target. You should have something you're targeting. Either you are trying to give your life, the whole family, the maximum protection, or you have to, your plan was to get a good benefit through savings. So all those should be in your plan. If it's to give the family, of course, the suggestion will always be, first of all, give your family a maximum protection. Now you can get one policy that is designed, attached for cash value benefits, but give your family a maximum protection first, before you invest. The way to richness is that you do what? Protection before investment. Because if you invest without protection, you can see that if anything hits, the whole thing crashes. But if you protect before you invest, if anything hits, already you are protected. It does not affect the investment. But when you invest before protection, if anything hits, since there are nothing protecting the investment, the whole thing crashes. The person will go back to square one. So that's why most times you see people that are rich today, tomorrow they are poor.
But they didn't plan well.
Yeah, you didn't protect. You have to
protect before investing.
Yeah, before investing, you have to do a good protection, so that if anything happens, you fall to your protection. Then you invest, you don't have any protection. If anything happens, the investment is gonna go, honestly. So unbonded premium, cash value, I don't think we're gonna talk anything about it. Universal Life Insurance Act transparency, they are characterized by unbundled premium. This means that the contract owner is provided with what? Information describing where the policy costs are allocated. Of course, unbundled premium is what we have discussed before. When you pay your premium is distributed to several channels. When you pay your premium for your life insurance policy, particularly policy with cash values, so you pay a premium today, that premium will be channeled to different areas for the policy to work. Unlike in term life insurance, you pay a premium, it's going straight to the insurance company to do the business, do anything they want. And that's why you cannot get it back, except you have return of premium rider. But in whole life or permanent life insurance, where you have a cash value, you pay your premium, there is nothing like return of premium rider. So what they do is that you pay a premium today, they allocate to different ways that it can be used. One, some of the premium can be assigned for death benefits or claim. Two, it can be for mortality charge, that to charge you the cost of insurance, mortality charges. Another one, it can be for expenses in the office. Every expenses on that policy come from the premium. And lastly, for cash value, some part of the premium you paid will return back to you in form of cash values. And now, because that part they are giving back to you, which the cash value, we now say is non-forfeiture. You cannot forfeit it no matter what happens. If you start to terminate or give up your policy today, they're going to give you back that part of the premium, which is the cash value. So these are what you should know. That's unbundled premium. Of course, the cash value of what we have discussed. Tax consideration. And remember what we said about MEC. Whenever you overfund your policy, what happens? The policy loses the life insurance identity that IRS is known for. It becomes an investment, and IRS will start taxing the policy, tax the policy yearly, tax the loan you take from it, tax the withdrawal. So that's what the tax consideration have to think about. So you don't need to go and, overfund their policy. If you make it a make, you put yourself into trouble. But however, pay to 7 pay. 7 pay is the maximum amount you can put in a policy for the first 7 years. And if you can pay 7 first, you have duly funded the policy. I'm telling you. If you pay 7 pay, you write a policy today, pay 7 pay. Oh my God, means that you have really in the next few weeks, you see a cash value. The cash value will start generating. Because what you have paid, the total amount you can put that policy for the first 7 years for the maximum there. What happened? This 7 pay comes every year. So you pay this year, next year you can still pay 7 pay. So that's why it's so good. All right, so let's look at universal life riders. The rider I've described riders before several times. Rider is just something they put in a policy to make it look beautiful. I've used pizza. I've used women. Normally, when the women want to dress up, they're gonna put a makeup.
Excuse me, Engineer Bat.
Uh-huh.
You say every year it comes, the 7 pay comes every year. How about the one you have paid already for the 7 years? It has not reached 7 years. You are paying another one. Is that
Because they call it 7 years does not mean that it must be 7 years. That is a term used for you to have a maximum funding on your policy.
Oh, okay.
Yeah. For now, you cannot just go like you pay this year. You go this year, you pay another one, then it's more than what is required. You funded it.
So you're saying that somebody can pay 7 years, next year pay another 7 years?
Yeah. It's accumulating for you. Yeah.
Oh, wow.
But the issue that how many people have the money to?
Yeah, but is it not like make will be like it will turn to make now?
No, it will not turn to make. As far as 7 is as far as the 7 pay.
Oh, okay.
Yeah. Make normally come when you do lump sum. You know what you mean by lump sum?
Paying at once.
Yes. You are paying everything at once. So
okay.
And even the life insurance, there's trick there too. Life insurance company can make it a way that they cannot be made. You pay at once. Because some big men pay at once too. Yeah. Because the only thing that they don't want to go against IRS laws.
Yeah.
That's the target. Nobody want to go against IRS laws. Nobody. Nobody. So everybody's afraid of that department. All right. So we have discussed about riders almost every time we discuss about riders. No lapse guarantee rider. What does it mean? No lapse. The policy will not lapse. Whatever happens, because you have that rider, your premium becomes flexible, your premium is setting, just like automatic premium rider. Who remembers automatic premium rider? When you will not be able to pay your premium, automatically the policy start paying itself. And it can only happen when you have a cash value. When your policy have generated cash value. So you see the essence of you trying to build a cash value, it can because you never know tomorrow. It can protect your policy for a long time. If you have a good cash value in your policy and you cannot be able to pay, that policy may last for you in the next 10, 20 years or 30 years without you paying the premium. So what happened? They'll be taking money from the cash value to pay the premium every month. Your policy is still there. Then when you don't have anything to pay, your policy terminates. That only happens in term life insurance. All right, so I think we're wasting time here. Index Universal Life. Index is one of the ones, if you want to write policy now, Index Universal Life. Why is index? You have a particular peg. The interest is pegged particularly in one, let's assume somewhere say 0.75%, which means no matter how the market is, even if the market like making crash, you cannot go below 0.75%. It gets 0.75% or and above. And I don't think any company is giving you up to 0.1%. Your bank, I don't know how many percentage is giving you to your that you're getting from your checkings and savings you're keeping in the bank. Maybe 0.001%. And that's why sometimes you can get 1 cent or 2 cents or 3 cents as gain. Now that this is a tax season, banks have started sending letters to people for your tax. And remember, that interest they give you is again, you have to pay tax on them. Because there's an income, even if it's 0.001%. So
You pay tax as ordinary income, right?
yes, now of course. That's why they send it to you so they can use it to fight tax. Even if it's 0.1%, 1 cent, you're still gonna send it to your tax man. So Index Universal Life, also known as Equity Index Universal Life, is a fixed, non-variable product that offers policy owner a third option, one that offers some potential for higher returns, but also ensures that policy owner will not lose money in a stock market downturn. So you see why everyone is going to Universal Life Insurance, Index Universal Life. Everybody can read this now and see it. Why? Everybody want to have a policy that's indexed universal. It's a fixed, non-variable. It does not vary. Product that offers policy owners, which is you, a third option, one that offers some potential for higher returns. Everybody wants higher returns, but also ensures that policy owners will not lose money in a stock market downturn. When the stock market is supposed to crashes, it's not your business. The index policy link their rate of return to a stock market index, such as SP 500, but the funds are not directly invested in it. Instead, insurers determine their rate of return based on the market index value at 2 specific points in time. If the index is higher, at the end of the period, policy owner receive percentage of the gain, usually capped at a stated maximum. So I told you that the most in index is always capped and is maybe they will say some companies will say our index starts from 0.7%, 0.575%, and it's capped at 0.75% upwards. It can be 3%, it can be 4%, it can be 5%, it can be even 20%, depending on market trend. So when you have universal index life insurance, you see that the growth you have in your cash value will be more. So in that case, if you're buying policy due to for accumulation, you can now go for it. All right, I think we are wasting time here. That is the main one we're supposed to do. Variable, of course, you remember what we said about when we see variable was in annuity, where we have fixed annuity, variable annuity, and indexed annuity. Now, variable insurance policies, we still have variable products. So you can see two of them, and most times it will confuse you. The variable insurance policy is a type of insurance policy. Variable products are what product that you and me cannot sell because we don't have what security license. And what are the variable products? You talk about the security transactions, such as what? Stocks, bond, and variable insurance product, which can be a mutual funds. So in those kind of things, we don't have ability or the license to sell them. Before you say such, you have to have life insurance license and security license. So most people who are really in the business of insurance and teaching, they have security licenses. I'll tell you. You have a lot of series. You cannot just get it once. You have a lot of series. Series 1 to 6. Most people get it. So why I want you to pay attention again is what in Security and Exchange Commission, SEC, and FINRA. FINRA is Financial Industry Regulation Authority, FINRA. And the Security Security and Exchange Commission, SEC. What do they do? SEC regulates security transaction. And what are the security transactions? Include stocks, bond, variable products such as mutual funds. Then the Financial Industry Regulation Authority, FINRA, is the entity that oversees security firms in the United States. They are a regulatory body that governs security activities in America. So these are the two things you have to know. You have to know what SEC does and what FINRA does.
So
FINRA
SEC,
is what? FINRA. SEC regulates security transaction. SEC, which is Security and Exchange Commission. What do they do? They regulate security transaction. And what does FINRA? FINRA is a Financial Industry Regulatory Authority. They are a regulatory authority. And what do they regulate? They regulate security activities. They administer security exams and they issue licenses. That was FINRA. So you have to know these two things. Definitely, you may see them in exam. SEC and FINRA. FINRA only regulates security transaction. Why? I mean, SEC only regulates security transaction. SEC regulates security transaction. Why FINRA do what? They are the governing body, they are regulatory body governing what? Security activities, administrative security exam, administrative security exam, and what? Issue licenses. That's FINRA. So please, know those two, they can come up in the exam.
Yeah, there was one question I was reviewing, that security exam, FINRA. They ask question like that.
Yes, you definitely will see it because they want to know whether you were able to differentiate variable product from variable insurance policies. So most times you see two of them confusing. You want to know what SEC is doing. You want to know what FINRA is doing. You want to know whether you as a person can be able to sell security products, of which you cannot. Because what? They do not have security license. Yeah. So variable life insurance, which is variable whole life. This is a policy now. We're not talking about product. So variable life insurance, VR, combine life insurance protection with investment opportunity in security, such as stocks and bonds. It features fixed premium and a guaranteed minimum death benefit. After deducting the cost of protection, what happened? The balance of the premium is what? Placed in separate account. After the cost of protection is deducted, the balance of the premium. Now you pay your premium. What they do, they deduct the cost of protection, which is all those costs we talked about before. What happened to the balance? The balance of the premium is what? Placed in a separate account. Remember, in life insurance, what do we do? It has a cash value. What do we do? The premium is divided into several different ones. The balance we put into cash value. But in what? Variable life insurance product, what happened? You pay the premium. The premium is what? Placed in separate account in terms of other things. I mean, place other cost of protection, which is very probably commission and everything. You pay your premium. Part of the premium goes for cost of protection. The other ones go to a separate account. In life insurance with cash value, the cost of protection goes. Now the remaining one goes to cash value. So you should clearly know that. So that's more reason why whenever you see variable life, make sure you know that it's talking about variable life policy and not a variable product. So have that in mind. So if they send it to a separate account, what happened? The owner chooses from a family of pooled investment resembling mutual fund, consisting of stock, bond, and this where he can able to put the money. So this one we get to direct investments. totally. All right, so I think we're almost done. I think that is it. So we're gonna rush to family plan policies and family income policy. Family income policy. We're gonna look at family income policy and family maintenance policy. The only difference with this one, the family income policy is a type of whole life with a decreasing term. This policy provides monthly income to beneficiary. Somebody has a policy. The person decides that, look, if I'm no longer alive today, the benefits should be done, should go to my family, should be paid to my family monthly as an income. So as they pay the money, if the money finishes, finishes, they pay the money until the benefit finishes. So that's what family income. You bought the policy, you decide to put the policy on the benefits as a family income to your family. So what they do every month, they're gonna pay them until the amount finish. So that's family income policy. Family maintenance policy. You only buy the policy. It's the same thing. This one consists of whole life and term life insurance, which provides income for a specific period, beginning on the date of the insured's death. If the insured died before the predetermined time, what happened? The policy provides income to a beneficiary for a stated number of years from the date the person died. From the date of the policy, the person died. So a family maintenance and family policy, there's not much difference about them. There's not much about them. Yep. So the only thing is this. The only difference about them is this. It said, additionally, beneficiary will receive the entire first amount of the whole life insurance component of the policy upon completion of the income paying period. So remember, in the family whole life, the benefit will be paid to you until it finishes. Now, in family maintenance policy, the benefit, it has a component that will be paid to you whole. Then the other ones they pay it to you as that paid like income policy until it finishes. Then when it finishes, that separate part they keep one side will pay to you in lump sum upon income paying period, upon the completion of an income paying period, which is just like family income policy. So it's just the same thing. The difference that this one has a two-part. When the income policy benefits finishes, they will now pay the lump sum money. So that is the difference. I think joint life, we talk about joint life. I want everybody to know this. You must have to see it in the exam. Either it will come in the insurance aspect or come in form of annuity. They are the same thing. Whenever you see joint life or you see joint life and survival, these are two different things. Joint life means that two persons are involved in that policy. When one person dies, the next person gets the benefit. That is joint life. Then joint life and survival policy means that two persons are involved in that policy. When one person dies, the next person does not get the benefit. The benefit only comes when the second person dies, the beneficiary will collect the money. So that's why it says survival. So joint life and survival policy means that two people have the policy. Normally, there's supposed to be two people have policy, one person died, the other person will collect the benefit. But no, in joint life with survival, if one person died, the second person will die before the benefit will be before the beneficiary will collect the money. So please, that is what you have to know. You have to know either it come in form of life insurance or it come in form of an annuity. In annuity, it's still the same thing. Any question on it? All right. Juvenile is what we have discussed before. Juvenile is when you put a policy for a minor. It's just a normal thing. The only thing is that the minor may not be required for a consent. You have the policy, He owns the policy. You decide what happened to it. Until you can hand it over to the minor in the form of assignments when the minor grows to a particular age. Then juvenile insurance, disability insurance, we call it, is there. If the minor is no longer there, I mean, if the parents or the guardian is no longer there able to pay the life insurance due to death or disability, what happened? The insurance company will come and take over. That is when you have juvenile insurance rider, rider, remember. All right, let's see. I think we go to chapter 5 now. We have done the most important thing. Yeah, modified dormant contract, which is MEC. We have discussed MEC before. Yeah. All right. I think we are done with this. All right. So that is. All right. So we're gonna go to. Oh, did I turn off my listen? All right. We're gonna go to chapter 5 now. Where we stopped yesterday. I'm sorry, everybody. We have to bring her to the test for her to at least know one or two things in the topic she did not participate on previously. So that's our agreement that anybody that going for exam, we have to leave whatever we do, go to that person and make sure the person is not enter her with fear. All right. So please, anybody can remember where we stopped? This particular chapter, policy, provisions, options, and riders, is one of the topics that you must see in exam, and it comes in a lot of ways. It comes as scenario questions. It comes as single questions. I think we have done long-term rider. Who remember rider?
Okay.
Policy dividends and divided options. Paid up the additional. I think we have done this. Life insurance policy riders. We have done this, I think. Riders.
Yeah, let me see.
I think we have done riders. Yeah, pay your benefit
Yes.
rider. We have done it, yeah. Pay your benefit, we have done it. Disability. Accidental death benefit. We'll talk about accidental benefit.
Yes.
Yeah, where we say what happened to when you have accidental death benefit rider, what happened?
Increase in the cash value or benefit value, debt benefit value.
Correct.
Right?
Yeah, that's it. So when you have this rider, accidental death benefit rider, I always like to say it because sometimes it comes in exam. When you have it, if the person died or caused by accident, remember it's accidental death benefit rider. If eventually that person died of accident, what happened? That person will get the the beneficiary will collect either double or triple face amount. So if that person has $1 million policy and has this accidental death benefit rider on it, and the person unfortunately passes, he has a $1 million policy, what will happen? They're gonna pay the beneficiary either $2 million or $3 million, triple.
This person has to die from accident or from any.
No,
If
it doesn't have to die, it's accident. That's why it's called accidental death benefit rider.
Okay.
Mhm.
The person
So-
must die from accident.
Yes, it's a triple. There is always a triple indemnity. And the triple can be it depends on what the contract says, but it's never the same. The what they're going to pay you is never the same as compared to what they pay you the first amount in ordinary policy. But because you have this rider, and it's not all that common because people don't think it as necessary. You understand? But for people who really can afford it, if I can afford every policy, all my even the air I breathe, I will if it's possible, I'll show it. No, that's the truth. If you can, After
Or
all,
it will give you more money.
if you live in America, it's not even about more money. It gives you the confidence. You see, if you live in America, everything around you is insurance. But the only problem we have, we don't put consideration into the insurance about our life. Everything around us is insured, but our own life, we don't care. That's the only difference. If you go to any store today, you buy something at we buy fruit crusher at the other day. I went to Walmart, we buy fruit crusher. When we come out to check out, they say, are we putting protection? No, but that's the truth.
Yeah.
The protection, I say, how many years? They say 2 years, or highest is 3 years. I say, what are the types of the protection? Is it when it stop working, or when it's damaged in terms of it fall on the floor and crash? They say when it stop working, that I know that it's not, the fault is not from me. Then they will replace it. That's the protection. So if the food crusher they can ask protection in food crusher. What of we that's going to buy the crusher? We are not protected. You buy phone, they say you put insurance on the phone. So America is about insurance. So if you have accidental death benefit rider, what happens? It doubles it or triple the face amount if the person dies of accident. Now, accidental death and dismemberment rider, AD&D. You can have AD&D as a policy in your health insurance. You can have AD&D. So for this type of rider, what happened? Some rider, accidental death rider may include dismemberment benefit as well. Dismemberment is that when that person has probably lost his hand, or lost his leg, or lost any part of the body. That's dismemberment rider. So of course, everybody knows. Who doesn't know what rider is? Because we are saying rider. I hope everybody here knows what rider is, so we can be talking about rider. So the thing we know, which everybody should know, is that when you accidental death and dismemberment rider is involved, they will pay you based on the severity of the accident or the severity of the dismemberment. So the death benefit paid under accidental death coverage is what referred to as the principal sum. The death benefit is the principal sum. The dismemberment or severance benefits paid under the accidental death and dismemberment rider is what referred to as the capital sum. So if the person have an accident, the death benefit is the principal sum. If the person lost one of his hand or his leg, the money paid is what we call capital sum. Most times, capital sum is often 1/2 of the principal sum. Maybe half of the principal sum is a capital sum,
Which is 50%.
which is 50%. So it's something else. It's something else. So, but remember, in accidental death benefit rider, what happened? They triple it. But in accidental death and dismemberment AD&D rider, what happened? They pay you 50% of the principal sum. They pay you the principal sum, they pay you again 50% of the principal sum. So you now calculate what if you bought $100, $1 million policy, you now have to calculate the half of it, 50% of it is 500,000. So they pay you 1 million, they still pay you 500,000 if you have this rider. Remember, you pay for the rider, it's not free. Riders are not free, but they are there to beautify the policy, to make the policy more beneficial. The more rider we are able to add to your policy, the more that policy suits your needs.
I have a question, sir.
Go ahead.
Let me use the 2 example again. Like you said, we shouldn't add the kids who are below 18. And what if you want to add a rider now and your rider is outside of the United States? What happens in that situation?
if you have a rider, if you add a rider, and your beneficiary is outside United States, is that what you mean?
Yes.
The rider does not have anything to do with anybody outside United States. But I think your question will be, what if you have a beneficiary that lives outside United States? Is that the question? Is that what the question is supposed to be?
Yes, yes, yes.
All right. So if your beneficiary is outside United States, if anything happens, they're gonna find the person and get it, and the person gets the benefit. People have come here to collect blood benefits.
Noted. Thank you, sir.
Who will give them visa?
Oh my God. That one is express. Because between the insurance company and the embassy. So your beneficiary can be anywhere in the world. In fact, the one I have, some of my brothers are there.
Noted, sir.
Yeah.
Noted.
They can come from anywhere. It must not be only here. And remember, when you are putting your beneficiary, Social Security is not a mandate.
Compulsion.
It's not compulsory that you put it. Just write the person's name, date of birth, and address. That's good. You can equally add a phone number if you like. The most important thing, write a good address that they can be traced. And write the person's name, a good address. Even if you have family address, write it down. They will address it. As far that person is a beneficiary, yes.
Well, this is a good question. I didn't know that.
Yeah. So guarantee insurable option rider, insurability option rider. Of course, guarantee insurability option rider (GIO) allows a policy owner to purchase additional life insurance coverage at specified date without providing evidence of insurability. If you have that rider, you can buy additional policy or add additional amount, or buy it. Of course, the first amount you are trying to increase it at your own time without evidence of insurability. Remember, I said earlier on that you cannot increase the first amount immediately the policy becomes what? Binding. The contract becomes binding. You can no longer allow to add more the first amount, more policy. For instance, if you have bought 500,000 policy, then contract is now binding. You now go back to insurance company and say, please, can you increase it to another, can you give me, instead of 500,000, I want to make it 1 million. Yes, you can do that within the period the policy is approved. Within the period that the policy has been approved and you have not the counter offer period, you can do that. But if the policy becomes binding, you cannot increase first amount. If you increase first amount, they ask you for evidence of insurability. In fact, the best thing for you would be even to buy a new policy. Because it's just like buying new policy. Because the evidence of insurability is your health condition. If they ask you of that, you give it to them. Now, if you look at this equally, the best it should be is to buy a new policy. You buy a new policy, add riders, other riders you need that will benefit you more instead of working on that old one. So since the rider specifies there's on which additional life insurance policy can be purchased, the policy owner can only make purchase using this option. So we said you cannot add anything in your first amount, of course. But if you have this guarantee insurability option rider, what happens? You can at any time add money to your first amount, increase your first amount. Yeah. So in that case, because of the rider you have, they will not ask you evidence of insurability or proof of good health. No medical exam will be required in that case. So if you have the rider, remember, this rider does not come free. You have to pay for it. So that will tell you that if somebody really designs the policy well, guarantee insurability of option rider is good to have. But you know, this kind of policy, this kind of rider will be expensive, so to say. So since this rider specifies specific death of which additional life insurance policy can be purchased, the policy owner can only make purchases using this option on those days or within a short window. General, 90 days. They give you even 90 days. So if upon the rider, they give you 90 days from the day your policy was issued to increase the first amount with the rider. So after the 90 days, you can no longer increase. You have to bring evidence of insurability. This is for So guaranteed insurability option scenario. Guaranteed insurability option scenario. Just what we said, but let's look at the scenario. These are some of the things you can see question on. Look at this scenario. This guy is age 21 years. Basic coverage is what? 25,000. He have guaranteed insurability option rider. Now, Leo is the name of the person. All right, let's start from here. He said, for example, let's us say Maria and Daniel purchased 25,000 whole life policy on their newborn son, Leo. The parents purchased what? $25,000 whole life policy on their son, Leo. For an extra $3 per month. This extra $3 per month, what is it? It's for this rider, guaranteed insurability option rider. So for an extra $3 per month, they add the guaranteed insurability option rider, extra $3 per month. So you see, I told you that riders is not something where you get free. It's addition. In fact, the best scenario is when you describe it with pizza. That's the best scenario. It's addition. Whatever thing you put, you add. Look at this one. As you extra $3 per month, sorry. Which means if you are paying $10 every month, what it means you're going to now pay $13 every month for you to have this rider. So they purchased the policy for their son, 25,000, and look at the time they issued the policy was when Leo was age 21 years. Now, the basic coverage in that policy is 25,000. The guaranteed insurability option, their rider there gives Leo the contractual right to buy up to 25,000 of new permanent policy called an option amount at each future option date. So what? No question about that, hobbies, occupation, or what? And the smoke, homos, or anything this class will be considered. So that's what happens in guarantee option rider. No evidence of insurability will come. So the person can go ahead and add anything within 90 days. All right. Guarantee insurability option scenario. We can't continue on this. Cost of living adjustment rider. So all these things we are talking about
virus
is rider. This one based on cost of living.
What was your last BM?
So if you
Please mute them.
I'm not feeling good.
all right. So cost of living adjustment rider will be based on the cost. You put the rider based in case if the inflation goes up. So this rider automatically increase the first amount of policy at specific interval based on increase in the customer price index. Decrease in the CPI do not impact the first amount. The CPI measures the inflation rate each year. So you use this one cost of living adjustment rider to fight inflation. Please know that cost of living adjustment rider is used to fight inflation. Just know that. So that whenever you see inflation, you're looking at what cost of living adjustment rider. So let's see. I think term insurance riders. We have riders in term insurance too. Level term, decreasing term rider. So level term rider has an additional fixed level death benefit of predetermined period and the predetermined cost to the existing face amount. So all those are riders added. Rider is something you can add to make the policy looks good. It can be. All right. I've been talking about return of premium rider. Look and read this. The return of premium rider is a type of increasing term insurance added to the whole life policy. When the policy died, when the insured died, the beneficiary received the first amount plus an additional term insurance death benefit equal to the cumulative total of all premiums paid during the life of the policy. Therefore, under this rider, the amount of coverage increases each year based on the accumulation total of premium paid. So return of premium rider, you can equally have this added. You are paying, remember, you are paying for it. You are paying for it too. You can add it to increasing term life insurance. It's an increasing term life insurance that you can add towards to your whole life policy. But did they return premium to you? No. So return of premium rider in the case of this one is that is adding more to you. They're not going to return out for you if you die. So that is what you should know. I think I want us to go get this done. This one's not, there's nothing here we're going to look. Exchanging. All these are riders. Life insurance policy exclusions. Yes. Let's briefly talk about exclusions in life insurance. Remember, we always talk exclusion. We have about 5 to 6 exclusions. Who can remember any of them? Exclusions in life insurance. What are the exclusions in life insurance? Does it mean that those exclusions, they cannot have policy? No. Does it mean that anybody who goes to war cannot have policy? No. But what it means that they are in a higher class of risk, which means they have a special risk classification their policy will be based on. Some
Like
people,
the people with a bungee jumping or a pilot, is that what
yeah,
you're?
yeah, all those were exclusions. So those ones they do.
Suicidal.
Mhm.
Suicidal.
Suicide, of course. Suicide is an exclusion. Is more especially affected during the contestable period. After the contestable period, suicide is no longer regarded as an exclusion because they're going to pay benefit. The somebody dies after 2 years after 2 years, and the person died of suicide.
Right.
Yes.
You're right.
That can happen. Can I help you? You say who? Who do you want to speak to? All right. So
Professor Berth,
go
you
ahead.
see, there's a topic that said hazardous occupations, a bizarre avocation. Like, like studying, should you focus on this chapter?
This chapter, I told you, this chapter is very, very vast. It's big, and most questions come from there. So if you see anything you can lay hand on this chapter, do it. It's very necessary, honestly.
Okay, yes.
It's very wide.
Oh, right.
It's very
You're right.
wide. Since
Okay.
it's very wide, is something you have to look at. If there's anything you can grab out of it, grab. Is most questions, if you look at it, those who have written before, you can look at it, see that they need more questions come from this chapter. Policy, provisions, options, and riders.
Okay,
But
thank
the
you.
most important thing for you to know, like if you know what riders is, whichever of them they talked about, you already by the word, you already know, since you know what riders is. That's why riders are easy to understand. So,
Right.
and the policy exclusions, of course, we know 5 or 6 of them exclusions, which we, just like we said now, suicide is one of them. War is another one. People on airplane, pilots and other air crew, all of them are exclusions. Somebody who mountain climbers, they are exclusions because they are high risk. Does it mean that those people can't get policy? No, they can get policy. They will get policy, but they're gonna be placed in a particular risk classification. Based on that, yeah, their premium gonna be so high. The premium gonna be so high. So you imagine somebody when a plane crashes, imagine the kind of benefit that the insurance company will pay. Because when your risk is so high, what happened to the first amount is so high too. What's happened to the premium is so high. Because the premium that can cover somebody who doesn't have a risk, who the risk is very low, will not be the same premium that can cover somebody who his premium is so high. I mean, who the risk is so high. So risk determines, classification of risk determines what? The premium. So that's why insurance companies do not joke with when you have a medical condition. No, they don't joke with it. If the one they can approve, they approve. The one they will not, they will deny it totally. To have avoid adverse selection. You know. So war is one of them. Let's look at aviation is another one. Aviation, which is people on the pilots and all the rest. So commission for felony, that is illegal activity, of course. So the illegal occupation, of course, intoxication and the narcotics, all those are exclusions. So somebody cannot go and drink to kill himself, then he want benefits. No. So if that person done it, they found out, then what will happen? The person got to take. Then avocation is what is like your hobby. Insurance can choose to exclude coverage for death resulting from individuals' dangerous occupation, hobbies, or avocation. Avocation is their hobbies. You know, some people, their hobby is a dangerous hobby. Some people, their hobby is to smoke. Some people, their hobby is to jump mountain. So don't you think that's a dangerous hobby? What can result in such hobby is what? A high risk and a high premium. So somebody who have a window washer, high-rise window washers. So those high-rise buildings, those who wash the window. Have anybody seen them?
Yes.
Yeah.
That's a very risky occupation. So that will attract much premium. Somebody who their hobbies is to scuba diving. That is a hobby. It's an avocation. A doctor who travels to developing countries to provide care. Can you see? I think most of us here, at least 90% of us are from Africa. Can you guys see this? Can you guys see this? Doctors who travel to developing countries to provide care.
Oh, I better not talk. Hi.
Is an exclusion.
Oh my God.
It's an exclusion. So you see, somebody who go to war, they are seen to somebody who go to developing countries as somebody who's going to war. So if you're a doctor, you travel to Africa to go and provide care, you are an exclusion. That's exactly what it's telling you now. You're an exclusion. Right. Oh my God, help us.
Some of these things are not fair.
It's
like this. Yes. So if I travel to Africa as a doctor to go give treatment, I'm at risk or high risk. And then if I go to Europe, I'm not a high risk.
Yes.
Where they kill more people.
No, you're not high risk. As far as you go to developed countries.
No, I don't think it's specified.
The policy is racist. I'm sorry.
Yes.
Did it say Africa? Let me see.
No, it didn't say Africa, but it said, look at it. I highlighted here what they said. It said
developing countries.
Avocation, e.g., a doctor who is traveling to a developing country to provide care.
Yeah, so I don't think there's specific, specific.
No, they didn't specify Africa, but
But
Because-
what did they have you? They have the
Because
African
you know why I
countries
said
as
no,
that?
every other country that is developing, including Africa.
They go against everybody. That's how they are. Even my country, because I cannot even carry back a mango in this country. So I mean, my country is the same way.
But let me tell you, there's even as we are saying this, if you're writing a policy and you are traveling to some countries, it's automatic denial. I hope you guys know. Yep.
Say that again, please.
If you want to write a policy and you have already bought a ticket to travel outside United States, I'm gonna say it here specifically. If you're going to Nigeria, some African countries and some other countries in the
Arabian
countries, if you are going there, you already purchased a ticket, you are going there, and you have a policy to write before you travel, already have a ticket, it's automatic denial. Because what? Is a high risk area. Yes. This one is applicable even as I'm speaking to you. Yes. So if you are traveling, if your plan is to travel, go and write all your policy. Make sure it's approved before you travel. Or otherwise, don't say you travel or you are traveling. Oh, let me do this now. My ticket, I bought it last month. I bought it for December. You bought it, you are preparing for it to go to December this year. You bought a ticket already. You want the right policy. It will be an automatic denial. You ask yourself, how do they know? All those things in the database, MIB will expose everything. If you are traveling today by ticket, it's going to the MIB straight. Again, if you cannot write policy for anybody who is outside United States, I hope you know. Because the person have to sign, and if the person is signing, they're gonna see that the person signed outside of United States. So, so there's a lot of things you have to encounter and you have to overcome. All right. So that is what we call exclusions. Exclusions. So it said, however, today most insurers forgo the exclusion and instead offer the coverage of an extra premium. An extra premium is collected, which is rate up, if a specified clause of causes of loss is excluded in the policy. It's excluded forever. If a cause of loss is not excluded in the policy, the cause of loss is covered forever. So hazardous hobbies or occupations may result what? In the exclusion of certain causes of death by endorsement resulting in a refund of premium paid. So if they found out that you put your head on such thing, what they will do? They refund you your premium. So carry your wahala go. They don't want to part their money with anybody. But the good thing is this, that we all are knowing this, and we all can educate our people. The more we continue to spread the education, the better for the society, better for our community, because basically, this thing is to bring our community up to a good understanding that we not fall short of things. That's just the truth. So in this business, a lot of people are needed to be able to spread this information. I'm telling you. Yeah, favor. Sorry, favor. Let me finish now. I put it. Sorry, I forget. Yeah, sorry. So that is it. That is what it is. It's just we all have to know, so that nobody will say, "I do not know." We all have to know. If you know it, you do it. If you know it, you tell your brothers, you tell your sisters. So if all of us become aware of what is going on, I don't think we fall victims. Is that not true? Because all of us are falling, honestly, tell ourselves the truth, all of us are falling victims to things we don't know. So most people, like when you start a business, if you talk to most people, they tell you, I got it all. They don't get nothing. Sit them down, In this, see that now I talk to them and the title they say, but initially they will tell you that, oh, I know everything, I know, oh, I'm good. They don't good anything. No. Until when you hit them, by then it becomes late. I'm telling you the truth. So suicide clause and provisions, already everybody have known that suicide is an exclusion. You cannot have if you have suicide, if you have a policy and the person dies within these 2 years of contestable period, they will not going to pay shishi to that person. No cent. No cent will be, no death benefit will be paid. But if the person die of suicide after 2 years, which is after the contestable period, the incontestable period, if it happened within the incontestable period, definitely they're going to pay the death benefit. So that is it. So of what they do, to them, they feel that the exclusion in this suicide is to what? To protect the insured from individuals who may be considering suicide, even as they applied for insurance. So some people will consider going to do suicide. They apply for insurance and they're approved, they go and die. So that's their reason for excluding suicide. So just like Mr. Kevin will say, who will go and die? Nobody will go and die. Some people will go and die.
Yeah.
No. Some people will go and die. So please. Yeah, how can I help you?
Oh. Okay.
It's about education. It's about people knowing what they're supposed to know. You know, if the people knows what they're supposed to know, we cannot be a victim. And in as much we are not a victim, our children will not be victim. And in as much our children are not victim, our children will not be victim. This is how knowledge spreads. But if we continue to be victim, what happened? Our children will continue from where we stop. That is just the basic truth. There's no this one. Prayer doesn't solve it.
Yeah.
Prayer doesn't solve it. I was talking with somebody, say, pray for Nigeria. You cannot pray for people who is hard-hearted. I'm just sorry for other people who are not from Nigeria. You just go and pray, say, somebody, a country where you see, they say, snake swallow money. You say you are praying. What are you praying for? Oh, God, help us. So the earlier we understand this knowledge, the better for our children. They will understand it. So what we're going to do, we're going to answer questions on this chapter. So we conclude this. In the evening, we start chapter 6. Let's watch this video and answer the questions. Now we concluded this chapter.
Congratulations on completing life insurance policy provisions, options, and riders. You've just unlocked a deeper understanding of how life insurance policies are structured and customized. We discussed how life insurance policies are built on a foundation of standard provisions. These include the entire contract clause, incontestable clause, misstatement of age provision, and the suicide clause, all designed to protect both the insurer and the policyholder. Policy owners hold powerful rights. They can name beneficiaries, borrow against cash value, and even assign ownership. Assignments can be absolute or conditional depending on the level of control transferred. For policies with cash value, there are 3 non-forfeiture options: cash surrender, reduced paid-up insurance, and extended term insurance. These options ensure policyholders don't lose their equity if they stop paying premiums. Now, policy loans allow access to cash value, but reduce the death benefit if not repaid. Automatic premium loans can prevent policy lapse by borrowing against the cash value to pay missed premiums. Next, we discussed how participating policies offer dividend options. Remember the acronym CRAPO? Cash, reduction of premium, accumulated interest, paid-up additions, and 1-year term insurance. You also discovered that riders allow policies to be tailored to meet individual needs. Common riders include waiver of premium, disability income, accidental death benefit, guaranteed insurability, and payer benefit for juvenile policies. Exclusions limit coverage in specific situations. These include suicide, excluded for the first 2 years, war, aviation, felony, and hazardous hobbies. Remember, the suicide exclusion is the only one that expires. By mastering these provisions, options, and riders, you're now equipped to explain policies, guide clients, and pass your exam with confidence.
All right, so we almost done from this one. So in the evening we're gonna start from chapter, or do we do the question in the evening? Which one is better? We start from chapter 6 in the evening. So a policy owner may generate what taxable income from which of the following dividend options? Where can a policy owner generate taxable income? Where do you think income can come out from these options?
Cash. Cash. Or future, for cash,
Oh, I think
accumulation of interest. Wow, cash.
It's accumulation of interest.
Any other person? Right. Two persons said
Taxable income.
it's accumulation of interest. The cash cannot come from non-forfeiture. Reduced premium is accumulation.
Oh, interest accumulated.
So whole life, whose life is covered on a life insurance policy that contains a payo benefit clause. Payo. When you have payo, what do you think?
Child, C.
No.
So whenever you hear payo, you're talking about children, juvenile. A policy loan is made possible by which of these life insurance policy features?
Cash value.
A policy loan is made possible by which of these life insurance policy? Consideration clause.
C. No, B.
Extended
Somebody give an answer. Somebody give B as an answer.
The answer is B. B as in Bravo.
B.
B. Then in a life insurance policy, which provision states who may select policy option, designate and name a beneficiary and be the recipient of any financial benefit from the policy? Who have that power?
Owner's right.
Owner's right.
C.
Right.
Charlie.
Two people say C. And who is that owner?
The insured.
The insured can be the owner, sometimes may not be the owner. The policy owner is the owner's right, the policy owner.
Okay.
All right. Who are policy owner? How are policy owner dividends treated in regards to income tax?
Dividends.
Dividends. You know what
Dividends are not taxable.
Interest on accumulations, D.
All right, so somebody said D and somebody says C. Somebody said C. All right, somebody said D. Any support so we can move ahead? Somebody said C, somebody said D. So any supports?
I said D as in dog. I don't know.
Right. So it says
C.
I said C.
Interest on accumulation is tax. Interest in accumulation is tax. Remember, I said it before. If you have a dividend is fixed.
It's not taxable.
It's not taxable because they have taxed it. The company have taxed it before they share the profit to you. Remember, profit is what? Expenses minus the tax. The what to remain is your interest in your company. If you, after a year's business, you check your expenses, you keep it by the side, you bring out what to remain after you minus the expense you did for the year. What to remain as a profit, you pay tax on it. After paying the tax, what remains after paying the tax becomes your profit. That's what you're going to share to the shareholders or to the policy owners. So since you have paid tax on it, those people will receive it as dividends. those profit, they're going to receive it as dividends. Dividends are not taxable. But if you decide to accumulate the dividends, there is an accumulation coming from the dividend. The interest on the accumulation will be taxed.
Okay.
But if you decide to collect the dividends as a cash immediately, you're not going to pay tax on it because it has already been paid tax on it before. So it's tax-free. But if you now say, oh, accumulate this money for me, then the interest on it will be taxed. Remember, I said there's 4 ways you can use your dividend. You can use it as collect it as a cash. You can use it to pay your premium. You can use it to buy more policy in form of term policy, or you can accumulate it. When you accumulate it, the interest coming out of it will be taxed. They'll tax you interest on it. Right. All of the following statements are true regarding a policy grace period, except what? You have to know what grace period is before you answer that question.
COVID continues, policy loans may still be made. Grace period terms are stated in the policy.
Past due premium are waived. That's D.
No, past due premium.
Do I know the person?
Yes, and dog.
Policy loan are still made.
Past due, of course. Right, this is a policy owner and insured for 50,000 life insurance. All right, this is something I used to say most times. I used to use it as a scenario most times. D is the policy owner and insured for a 50,000 life insurance policy. D beneficiary is D's wife. D and his wife divorced, and D remarries, transferring ownership of his policy to his new wife. If D dies without making any further changes, to whom will the policy proceed be paid to?
A.
The ex-wife.
And the ex-wife.
Yeah,
Yes.
I used to say this every time. So
Yeah, you're always making it as a scenario.
yeah, it's to the ex-wife. So D owns a whole life policy that was purchased 10 years ago. If the premium payment suddenly stop and it takes no additional action, which non-forfeiture option will the insurer likely proceed with?
Extend term, loan
Loan provision. Extend. Hold on. Loan provision. Extend term. Reduced payout. Oh. Not forfeiture. Hold on. Additional. Extend time. Extended
Another
time.
person, I think I'll be. It's extended term.
Yeah.
All right. T took out a 50,000 life insurance policy with an accidental death and dismemberment rider. 5 years later, T commits suicide. How much will the insurer pay?
That's 5 years later.
5 years
Okay.
later.
And
C. The answer is C.
B. B.
No, it's C. They're gonna pay everything because it's more than 2 years.
You remember what I said? After the incontestable period, you don't talk about suicide again.
Okay.
They must pay.
Okay.
So this one say in a life insurance contract, the insurance companies promise to pay the stated benefit is called the what?
Insurance clause.
Insurance clause.
Clause.
This one, nobody's supposed to fail this one. Then which of these are not an example of non-forfeiture option?
Life income.
Life income.
Reduce,
A.
extended term.
Any other person? I'm gonna rush. It's life income.
Yeah.
The automatic premium loan provision is designed to do what? Automatic loan provision, what is it designed for?
Avoid policy lapse.
Huh?
Avoid policy
That's
lapse. A.
Is avoid policy lapse. I think because I'm trying for us to finish quick, I need to start something now. So
Okay.
what does the insuring agreement in a life insurance contract establishes the insuring agreement. Remember, insuring agreement. What does it establish?
And
Is D.
basic promise.
D.
Huh?
Basic promise.
It's a basic promise. Or that
Promise
promise,
to pay.
that remember that
Promise to pay.
Yeah, that promise is conditional. I hope you know.
Mm-hmm.
What is the condition attached to it?
Independent on if there is a loss or not.
Good.
Oh, yeah,
No,
that's true.
it depended on the loss. If the loss does not happen, will they pay? No.
No.
All right.
Oh,
So what provision in life insurance policy states that the application is considered part of the contract?
The entire contract.
Say the entire contract. Of course, it's entire contract. Now, Chinonye, you have to go and write out the exam.
I'm writing. I told you now. It's next week now. I'm ready.
Yeah, no, you're ready. When does a guarantee insurability rider allow the insured to buy additional coverage? Which means before you come to Dallas, you'll be an agent.
Yes, I'll be a license.
You're an agent. So when does a guarantee insurability rider allow the insured to buy additional coverage? When?
At any time while policy is active, at future dates specified and so wouldn't that
C as in Charlie.
C. Let's see.
C as in Charlie.
Is at future dates specified in the contract with no evidence of insurability. Remember, guaranteed insurability rider, you are waiving the question of bring insurability.
Okay.
Whenever you see guaranteed insurability rider, it's waiving out the
issue.
Okay,
waiving out. Okay.
Yeah, it's the issue of insurability. You do not need any evidence of insurability to add to the information or anything to your policy. That is waiver because of the rider. However, you pay money for adding the rider. I hope you know.
Okay.
So what action will an insurer take if an interest payment on a policy loan is not made on time?
Automatic add the amount to interest. Okay, wait though.
And so subtract from any dividend earned, automatically add the amount of interest due to the loan balance. But we're not talking about loan.
Oh, take D. D as in dog.
Well, somebody make it's like Austin. Austin said D.
No.
Somebody said D, all right.
So
it's automatically add the amount of interest due on the loan balance, of course.
Yeah.
That's what it is.
Yeah, them said D.
So this one said, which of the following provision guarantees that premium will be waived if a juvenile life policy owner becomes disabled?
Payor clause.
Payor clause.
C as in Charlie.
Payor clause. Yep. So juvenile, in questions, if you see juvenile, look for payor. If you see child, look for payor. So this was which statement is true regarding to a policy loan?
Insurance company can send delinquent interest account. Company can charge an interest rate based on the policy owner's credit report. Past due interest on a policy loan is added to the total debt. Yes, that's it. Yes, see.
Somebody says here already. All right, good. Past due interest. A life insurance policy which ensures that the premium will be paid if the insured become disabled has what kind of rider attached to it?
Return waiver ensure that premium will be paid. Yes, living shall become disabled. Return premium, waiver premium, Accelerated premium,
Is the
waiver?
waiver of premium.
It's waiver of premium.
No.
Yeah, it's waiver of premium. Sorry, we are not discussing the one we're supposed to discuss, but additional coverage can be added to a whole life policy by adding what? Additional coverage. What do you add?
Automatic decreasing term rider. Accelerate. No, is that decreasing term rider? See?
A automatic premium loan or rider.
Decreasing term rider. It's a additional coverage can be added to a whole life policy by adding what? It can't be premium rider. Right. I think that's it for this.
But we have tried, you know.
That's it for today. In the evening, we're gonna do chapter 6, which is life insurance premium proceeds and beneficiaries. So that's what we're gonna do in the evening. By 6 p.m. Even if I did not post it, please know that by 6 p.m. we gather once again. So I hope everybody here have registered for your exam. And remember, we said we are providing accommodation for those who come to Dallas February. So if you have registered, if you have bought your ticket, snap your ticket, send it to us so we can be able to make arrangement for the accommodation. And please do it this week. All right, see you guys in the evening.
Thank you.
Thank you.
Good evening, everyone. I mean, good day.